We are living in the age of Donald Trump, AI, geopolitical dislocation. And the urgency around climate that we saw a few years ago seems to have dissipated. Those of you who were in the audience yesterday morning for our audience poll will have seen that climate volatility, of all of the risks facing the world, in terms of what our audience sees the risks facing the world, climate volatility ranked lowest of all the risks facing the world. So you'd be forgiven for thinking that climate had completely vanished from the outlook of investors in the world, but we're here to discuss how that's not the case. And it's interesting, I was looking at on my Bloomberg terminal yesterday, the S&P Global Clean Energy Index is up 44% this year. That's nearly as much as gold. It's more than 4 times the return on the S&P 500, and it's even more than NVIDIA. So it's not like climate action or climate investment stopped while the world became transfixed by AI. There is a lot going on in the background, and that's what we want to dig into here today. But Ruth, let me start from you. You have come here all the way from Belém, where you attended COP. Can you just, before we dig into the investment perspectives, can you just give us a little sense of what was the mood like there? What was the sort of private sector involvement like? Tell us. Yeah. What was your accommodation like?
Well, I was fortunate with early planning. I was okay. So first of all, before I answer the question, I do want to say thank you to the Bloomberg New Economy leadership team for putting this on the agenda and on the plenary stage, because you would be forgiven for letting it fall down lower on the agenda, but it's so important. So they took in Brazil a different approach with respect to private sector engagement. And I think it's important to go back to COP26, when really the private sector was first brought in. And I think we all in this audience recognize the fact that we won't drive the change that we need if you don't have the collaboration between the public and the private sector. And with each subsequent year, it got closer. And so I think Brazil did a great job with a new innovation of standing up the Sustainable Business Cap. And they followed the model of the B20 and the G20, so that there was one strong voice from the business community where they had engaged with chambers of commerce around the world to bring it forward to the negotiators in a concise way. What did the business community think with respect to priorities? And the hope out of Brazil is that's a legacy that this presidency leaves, and that it gets handed off to the next COP presidency.
And in terms of private sector initiatives and innovation, what was the most interesting thing that you heard there while you were on the ground?
Yeah, so one of the things that was really interesting is that they did gathered people in Sao Paulo the week before to really bring together the private sector. A lot of the focus was on implementation and action. And so there was a lot of discussion about the fact that we are past the time of making commitments and more down to the concrete with respect to what is necessary to drive the transformation that we need. And I think the other thing that struck me was, just like the discussion we're having now, the private sector did show up for the conversations, and I think that's really important.
Yeah. So, Olaug, let me turn to you on that. So, you run one of the biggest banks in the Nordic region, and one would be forgiven, given the ESG backlash, everything else going on. You would be forgiven for thinking that companies had thrown in the towel on sustainability. What are you seeing on that?
Well, they are not, absolutely not. I mean, we see that there is a backlash, but the companies are really adjusting and have high on the agenda the sustainability, and they cannot afford not to do that. But it's a reset, and the companies have had to adjust to the fact that the policies have been changed in the US, as you showed too. Downscaling there. In China, you have seen tremendous growth on renewables. And then in Europe, it's more like in the middle. We did have the Green Deal. Now it's more on competitiveness. So companies have had to adjust to that, and also have to adjust to what took place, with the ESG hype, if I may say. Where investments have been, haven't given the return in the real economy as expected. So we see that the companies that we follow, they do have sustainability on the agenda. It's more back to the fundamentals to see how can how do you have the business models that are resilient, that take into account the risks and the opportunities within sustainability. So that is very much, I think we will see more longer-term effect. So it's a reset for the companies. And investors, they expect the companies to do have a sustainability strategy. We had done a survey with leading investors in Nordic, and they all expect the companies to have sustainability and ESG on the agenda and have specific targets. And we as a bank as well, we expect the companies to have a prudent long-term transition, strategy. So very much on the agenda.
And just for the benefit of our audience, could you give our audience a sense of the universe, the geographical universe of your client base? Is it mostly Nordic companies? Is it mostly European companies? Because that rings true, but I'm sort of wondering, does that also apply to US companies?
Yeah, well, we have a Nordic banking, but we are leading into sectors that is important for the Nordics. So we have a global leadership in renewables, energy, shipping, ocean services. So these are companies that also invested globally. So, and yeah.
Before I turn to Mark to talk about investing opportunities, Olaug, perhaps can you tell us a little bit about what lessons do you think we've learned over the last 5 years? 5 years ago, there's a lot of talk this week about AI bubbles. 5 years ago, perhaps now in retrospect, we were seeing a green bubble. What have we learned since then? And how can we apply that going forward?
I mean, it's a good question. It was, we have to say today, in retrospect, it was a hype. And we have to remember interest rates were low. The policies were quite clear that we should have a green transition. And companies were very optimistic and saw the opportunities. Investors, we didn't have we're not critical enough, so it was over-optimism. So always lessons learned from that. And then interest rates came up, inflation came up, and it was, we didn't get the effect from the investments in green solutions as we should have had. So lots of loss.
Lots of lessons.
Yes.
Mark, before we talk about the lessons, what are you're the investor on the panel. Where are you putting your money and why right now?
Well, first of all, just to say Aviva, I'm the investment arm of Aviva, but Aviva as a global insurer, climate change is existential risk to insurance companies. So, I mean, it's definitely never been forgotten from the insurance sort of mindset. But the reason to have faith in investments is there's so many different places to invest. So for a long time, we've been investors in renewable energy. We're one of the largest financiers of offshore wind in the UK. But we've been shifting more recently to the demand side of the equation. And in particular, we're looking at decarbonising industry. So we invest in infrastructure that actually goes on site onto industrial plants, so providing solar, battery energy storage and batteries, heat pumps at industrial scale, saving heat as well as energy if they're creating extra heat, electric vehicle fleets. So actually decarbonising the light industry is actually really investable right now. And why does it work is because we are getting a long-term contract from the industry, which is what we're looking for as financiers, but it lowers the cost. It's simply the maths. The finance works. It does lower the cost of those industries. It also creates energy price stability, which is something the industry is incredibly focused on, particularly across Europe. So we're seeing quite a lot of demand now for that kind of infrastructure. So moving not from just the supply side to the demand side too. And then in the venture space, there's a lot of focus on climate tech for the future. It still, has yet to be proven to be investable at big scale at the sort of my more pension fund side of my business. But as a venture business, it's really showing some great green shoots.
By that, are you talking about hydrogen, carbon capture, that sort of frontier tech?
Yeah, more the carbon capture side, I think. I think hydrogen still needs a lot of support from governments. It's definitely not investable at scale when we look at it from the institutional side, but it's coming. We don't need it for the sustainability journey, maybe for 10 years or so. So there is time. And that's why, as a good venture investment, then you need to spread your risk across multiple companies. But the winners will get the follow-on rounds of funding, and then eventually, then they'll get the big financing, like we do now for offshore wind, in the hundreds of millions for every ticket that we write.
I know this is a very, very broad and perhaps unanswerable question, but when you look at clean tech or some of the other infrastructure investments you're making, like in large-scale heat pump deployment on an industrial installation, what kind of returns are you looking for, or are you getting?
Yeah, so for decarbonising industry across Europe, then we should be able to get an 11% IRR fairly straightforwardly. So that's really good for long-term pension scheme investors. It's relatively low-risk investment, so it's not the early stage at all. This is proven technology with long-term power price contracts from industry, and these are big names in industry. So it's very, very credible investment strategy.
If there are investors, people in the audience looking for a higher risk opportunity, what would you sort of point people towards? I mean, carbon markets have sort of been on the dawn of carbon markets for a long time now.
So carbon markets are working. So we have a carbon removal fund. Right now, most of our focus is on nature-based solutions, and a lot of the value being created is in the carbon markets. We're starting to see investors starting to look at a fund like that rather than just for offsetting purposes to get those carbon credits to offset their own carbon emissions. We're actually starting to see investors look at carbon as an asset class because they think the price is just going to keep going up. So actually, why not invest and get that diversification, looking at it as a completely different asset class? So, but right now it's more nature-based. That will have limited capacity. There's only a certain amount of land that can be used. Then we move on to engineered solutions. At the moment, as I said, that's more venture. That's where the higher returns are, of course. But the large scale yet to come in that sector. We need a lot of government support still in that sector.
Yeah, we're going to get back into the government, what governments can do in a minute. Carbon markets, of course, are famously fragmented. Is there a particular carbon market where you're seeing most interest right now, if you look at it globally?
Well, I think Singapore is one of the great jurisdictions of leading the way there. So the UK, it's working. You can now get accredited carbon credits. You need the true carbon credits, where it's actually carbon removal. I think there's now a very good independent verification of that, and Singapore is right at the heart of everything going on there.
Olaug, it's not just about renewables, of course. It's about lending and transition finance. When you look at your books, is the demand for transition finance growing, or is that sort of steady at a low level?
Absolutely, it's growing, and we see great opportunities there. And we, as a bank, we have taken a position to support all the customers in the journey, in their transition journey. And we have many hard-to-abate sectors, like energy, shipping, and we see a great demand from our customers into transition finance. So we have said that we have set a goal on how much we want to invest in transition. So it's 150 billion until 2030. And the point is that when we support our customers, that's part of the transition finance, is that they commit to certain achievements on, for instance, emissions. So the price on the products or on the loans is connected to the companies achieving certain KPIs. Also we have into the corporate bond market. It's big in the Nordics, and over 30% of the corporate bond market has a sustainability link to it. So it's very popular, and again, we support customers in the transition. not only with capital, but also with competencies. So transition, the brown and grey to more green, that is an important responsibility we have, and we say that we want to be a driving force in the transition. And it's very, many companies take up these loans.
Roughly what percentage of the loans that you give out are transition finance right now?
I would say that the transition finance around 800 billion. So we are halfway to our goal to 1,500 by 2030. And again, the corporate bond market, that's around 30%.
Okay.
We're seeing a lot of green loans in real estate now, actually. So if a real estate owner will agree to lower the carbon footprint of the building, we'll actually build in a lower rate for them on the lending. And the reason that works is because actually the energy efficiency of the building is going up. So it actually becomes a better quality building. So it adds value to the building. So it's actually the correct...
Over time you spend less running the building.
Running the building. So it's cheaper to run, which people then want to rent it more. So it increases the value of the building. So the lending can actually be offered cheaper. So
what's the differential roughly? I mean,
it's probably about 20 basis points, something like that. But that's actually quite meaningful over a long period of time for these borrowers.
Yeah.
If I can add, for instance, give you an example on shipping. We see all the ships out there in the bay, and the shipping sector, they account for around 3% of emission. That's a lot. And supporting these shipping companies in their transition is important, so that the loans could be used to specific technology that reduces fuel, reduces emissions, or open up for more sustainable fuels going forward. So I think, work with the shipping, with the industry, supporting them in the transition, that is very important going forward.
Because climate is a story in many ways about market failure, about imposing the negative externalities of capitalism get imposed onto the rest of society. And it's also an area where we still need government support to get things going. Mark is an investor, Olaug is a banker, but you're a non-profit. Carbon Measures has a very specific approach here in terms of dealing with market failure. Can you tell the audience a little bit about what you do and how Carbon Measures tries to address that?
Yeah, absolutely. So Carbon Measures is brand new. We launched on October 20th. We're a business-led coalition where we brought together industries from around the world and across the value chain. So we have energy companies, we have steel, we have chemicals, we have financial services, we have public accounting, we have transport across the board. We've got strong coverage and we're looking to grow. But the problem that we're trying to solve is one of the demand side, like you talked about. And so while there are now some signs showing that emissions will start going down at some point in the future, we know that it's not fast enough. And we also recognize that the world still does need more, whether it's infrastructure or it's homes where your electricity reliably turns on or it's data centers, that demand is going to keep going up. And so what we're looking at is how do you align the market incentives to the actions that need to be taken in order to drive down emissions. And what we find too often is that there's amazing innovation, but these startups can't find or indicate that they have sufficient demand on the other side to get the investment that they need, or large companies are investing in low carbon solutions and again don't find the demand on the other side. And so if that's the case, we're not going to get the investment and we're not going to get the transition. So what we're looking at is two things that we think need to be done in order to create the conditions so that there's better and more durable demand. The first, and forgive me, I'm a CPA, so it's a little bit nerdy, but the first is that we need carbon accounting that draws on the principles of financial accounting and science so that we rise up to the level of a generally accepted approach to measuring carbon emissions at the product level. What that allows for is comparability and it allows for companies to differentiate their products so that they understand that if it's a ton of steel from company A and a ton of steel from company B, you can do the comparison to understand what you're buying. But better data alone is not going to drive demand. And so you need regulation in addition. And so what we're focused on is product level regulation and product intensity standards. The reason why we're focused on product level is because it has worked. So if you look at how we solved the ozone layer issue, how we solved products that were driving acid rain, we all have seatbelts in our cars, like this works. And so we think that if you have the combination of the precise accounting that allows product differentiation and a target at the product level that companies have to hit, you now get market recognition for driving down emissions.
But those products, I mean, I don't think the Trump administration will be imposing carbon intensity standards anytime soon. So you need, for this to actually happen in the real world, you need big markets to actually impose those standards, apart from the US. Where do you see that happening?
So you already see some level of focus on intensity standards or product level regulation. So we've got CBAM coming on board. It's different from what I described.
Maybe tell the audience a little bit about CBAM.
Yeah, so CBAM coming out of the EU is the way to make sure that you're not allowing for carbon emission leakage, right? So that you've got regulation in the EU, but if you don't have a mechanism to make sure that it's just not, the emissions aren't offshored, that's what CBAM has been put into place to address. So that's a product level regulation. Out of China, you've got intensity standards that are coming on board. And one of the things that would help from a private sector standpoint is to drive more harmonization with respect to how the regulation is done. So I'm not saying it's going to be an easy or a overnight journey, but we do think it's one that can be accomplished.
And companies are going to have, I mean, two examples you mentioned, China and the EU. Companies are going to have to think about this, right?
Yeah, absolutely.
Yeah. I'd like to talk a little bit about government as we come towards the end. Mark, what more, and please everyone feel free to jump in terms of crowding in private sector money, what more work do governments around the world need to do, or where are you seeing maybe the best examples of that?
Well, I'll start with the UK. I sit on the Net Zero Council of the government, and that's an initiative which brings together finance and industry together with government to help create a policy environment that is conducive to investment. So the UK's just launched its carbon budget delivery plan with very stretching targets for it to hit. But there's various areas of focus that are really going to drive future investment. So homes is probably one of the biggest. So new homes in particular, standards they're going to need to have so that new homes have heat pumps, have solar, as many places they can. So if that sort of policy can be brought in, that will be a game changer, just like it has been for electric vehicle where policy is brought in. I think that stability, long-term commitment that you need from government in order to get long-term investment in is absolutely critical. So we've spoken about the EU and the UK. I think that's where, for long-term infrastructure that links to renewable or to decarbonisation, that's where a lot of the focus is right now because of just that government focus that's there. They're going to have to do a lot of work on heavy industry. Now, that is going to be where carbon capture and underground storage comes in. I think those hard-to-abate sectors like cement, like steel, they will need a lot of support from governments. And that will probably be of some sort of incentive or tax incentive if it's not sort of direct incentive. And then to crowd in, then most governments have now got lots of wealth funds which are looking at taking that first loss risk, which is essential again, particularly if there's technology risk involved. So an insurance company like Aviva is not ready to take on large technology risk. We want proven or relatively proven revenue streams. So this is where government can come in and take that early stage risk or take the first loss risk. And then we can then be crowded in with large amounts of finance that can come in on top of that. So the combination, the blended finance that's then created, can actually make a difference.
Is that happening? Are there concrete examples?
It is happening, yeah.
Oleg, or you can jump into
Yes,
it.
I echo what you say there. One additional point is that the policies, many of these investments are very long-term, lots of capital, and then you cannot have sort of surprises in policies. You do need to have long-term. For instance, in the U.S. on offshore wind, where the federal government had stop order in the middle of a project of offshore wind. Of course, that is devastating. So not what government can do, but what they should not do. So have long-term policies, that is important.
Mark, you touched on the insurance industry at the top. My previous job, I sort of oversaw, I ran Bloomberg Green, and we wrote a lot about the uninsurable planet. Where are you, which parts of the world do you worry about most in terms of the insurance industry pulling out, and what does that mean for long-term investment?
Yeah, so a lot of insurance is obviously linked to weather.
Yeah.
And so housing in certain parts of the world is becoming very uninsurable right now. At the moment, a lot of insurance companies will still insure because they can reinsure the risk away. So it'll be the reinsurance market that cracks first, that says, no, we're not taking on any more risk of a certain region from flooding or from fire or from storm damage. So when that reinsurance market cracks, then you will suddenly see, huge increases in pricing of home insurance. And then, the population, winning the hearts and minds of population is one of the hardest things in addressing climate change. But as soon as prices of insuring your home goes up, then you're suddenly going to have a lot of people wanting they'll hurt their pocket.
If you had to guess, where do you think the reinsurance market might crack first?
I think it'll be flood risk. That's where we're seeing it. But the governments are already having to step in and create schemes themselves. So even in the UK, we have a flood reinsurance program which allows communities to still get insurance. Without that, the insurers almost certainly wouldn't be insuring certain areas.
Yeah.
One thing that will be interesting is litigation on climate damage. So we are seeing more lawsuits coming in, actually attacking corporates who they're claiming are creating climate damage. So that is covered at the moment in insurance policies. So the director and officer insurance. So again, if the reinsurance market starts to say, well, hang on, we're not going to start insuring that, then you're going to find it harder for directors and officers to get insurance. And then, of course, all the boardrooms will suddenly be a bit more focused on the risk that their company is creating.
Yeah. I have one question from the audience, which any one of you is free to jump in and take. What are the views of the panel on the role of nuclear energy for meeting the combined challenges of climate mitigation and energy demand? Is nuclear, is it an interesting investment opportunity right now? Are you seeing any lending for nuclear projects?
We are not into nuclear. Norway's oil and gas and renewables. But in Sweden and Finland, you do have, of course, that energy source. But that is a very long-term horizon for nuclear to be an energy source. I don't know if you are investing.
Yeah, so the UK government has just committed to a whole range of small modular nuclear reactors. So it's coming in the UK, and obviously Sizewell C is now underway. The financing rounds are starting, so it's going to be a big question that we're going to be looking at. But I think from an pure investment standpoint, it should be quite attractive.
Yeah, okay.
And I'll just add different countries have different access to different mixes of energy. And so I think that we've got to look at all varieties to meet the needs of communities, and whether it's incorporating carbon capture to make sure that we're addressing emissions, or it's nuclear, it's solar or wind, we're going to really need all of in order to meet the demand.
Ruth, I'll give you the final word. I think, Mark, you're based in London. Oleg, you're based in Norway. You are based in the US, which is sort of ground zero of the backlash on climate right now, it seems. In this sort of weaponized era that we're in, how do we talk about climate and climate investing in a way that doesn't make people run for cover right away?
What I find is that when you put it in the terms of business, it becomes much less controversial. And so organizations need to think about what are the risks that they face that they need to mitigate. How is the demand from their customers changing? And no matter where you're based around the world, if you've got customers based particularly in Europe, you're getting different demand signals than you have in the past. And then what are your opportunities for growth and differentiation related to all of the, the energy transition opportunities that we just talked about? When you put it in those terms in the language of business, there's much less pushback.
Well, on that pragmatic note, thank you to my panel. We're out of time. Thank you.
Thank you.
Thank you.
Thank you.